month, we speak to one of our investment partners to tell us a little bit about their investment asset class and the market. Today, I'm joined by Steve Byrom, founding partner of Potentum Partners, an investment management firm that looks for and sources global investment alternative opportunities for their clients. Potentum Partners was founded 5 years ago by the team that set up the private equity investment program at the Future Fund, Australian sovereign wealth fund. Today, Steve will be talking a little bit to us about private equity and venture capital. For those that are new to the investment asset class, I highly recommend you listen to our last episode, which is an interview with the CEO of Hamilton Lane, and there's a bit more of a primer into private equity. Steve, thank you for joining us today.
Thanks, Joey.
Maybe we can start a little bit about telling us about yourself and Potentum Partners.
Yeah, thanks. So look, Steve Byrom. I've been around private equity markets globally for over 30 years now. That does make me old. I've got grey hairs for a reason. I've done during that career, sort of touched all aspects of the private equity industry. But I've spent the last 3 years now as a primary principal investor. And I think that's a really important distinction, because there's a lot of people in this asset class that actually don't operate as investors. They operate as gatherers of fees. And I've been, and the co-founders at Potentum have been operating as investors for a long time. So I've worked, my co-founder Dave Simons, he and I have worked together for 18 years now, and Jasmina Osmanovic, Dave Simons and myself, who are the three co-founders of Potentum, we were at Future Fund together prior to setting up Potentum, and we've worked together now for 11 years. So a lot of consistency in that team.
Yeah, great. And you mentioned private equity there, and we've talked a little bit about private equity before. How do you think about the term private equity? What does it encompass to you?
Yeah, it's a term that's thrown around a lot, and it can mean different things to different people. But what we're really talking about here is the unlisted equity class, right? These are unlisted assets, unlisted companies, access to private companies. And it's a much, much bigger universe globally than the public company listed market. And the term private equity can encompass every stage of the life cycle of a business, from startups and inception, which we tend to call venture capital, through growth equity, into more mature companies, which can be called buyout, or some people will call that private equity as well, just to confuse people. And then through the sort of later stages of the life cycle of a company, through turnarounds and into distressed debt purchases and distressed asset purchases. And so we can cover all facets of the life cycle of a company in the private markets. And that's the way we think about it.
And what is the biggest issue an investor needs to consider when investing in private equity?
Yeah, look, we're very focused on alignment of interest, and if you kind of asked me what my biggest three issues would be, it'd be alignment of interest, and alignment of interest. It is amazing, if we think about where this asset class came from, where private equity came from, was around a poor alignment of interest in the public equities between owners of companies and managers of those companies. And it touted a superior governance model, which led to better returns. And that holds nicely between the manager of the company, the people running the company for the private equity fund, and the managers of that private equity fund, right? That alignment of interest is there, and it's for good governance. But it breaks down between the manager of the private equity fund and the ultimate investor that's putting the capital to work. And in the overwhelming majority of cases, we see massive misalignments of interest between investors and the people they're allocating the money to invest on their behalf.
What are you looking for to tell that a manager has a misalignment?
Yeah, a lot of it's in can be buried in their documentation, but a couple of really big ones are around, what are they actually, it's all about incentives, right? And so what are they actually incentivized to do? If you had a manager that's building a fund, or has a fund that they're raising, but their key incentive is their public stock options in their public company, right? Then what are they motivated to do? They're not motivated to provide returns on the fund. They're motivated to grow the assets, because that's what rewards them on the public company side. So a lot of it comes around incentives, incentive behavior. I think the other big one we see around misalignment of interest in that regard is people whose fee model is around growing assets under management, right? And so they're not actually motivated and incentivized to provide high returning assets. They are motivated to hold assets and keep assets. And when we see things go wrong in this industry, it's generally because people have done what their incentives incentivize them to do.
Okay. And moving on to returns, it's a widely touted fact that private equity delivers superior returns to public markets. I know you have a view in that. Can you share that view?
Yeah, certainly. So what we see is over sort of any period of time, and particularly longer periods of time, somewhere between a 0 to 2% outperformance of public markets over that time per annum, over that time interval, right? And so yes, private equity does outperform public markets on the face of it. What I think that doesn't account for is the risk, and just by the fact that you're dealing with a more illiquid asset, that illiquid asset tends to have more leverage on it, means you should be extracting a higher return for that higher risk. And so, my question would be, is 0 to 2% enough to compensate you for that high risk? I don't think it is, right? The benefit in that then is that, around that sort of mean return of 0 to 2% above public markets, there's this very large dispersion of returns that different managers generate. And that large dispersion is driven by either, being lucky or being skillful, or a lack of luck or a lack of skill, depending on which side of the median you are. And the nice thing about skill is it's highly repeatable. And so what we like to see is people who are in kind of that right-hand tail of the dispersion, who are repeatedly generating outsized returns because of that skill level that they're applying.
So looking for managers that specifically have skill will get you the higher returns, more so than the average outperformance over public markets, which then starts to justify the extra risk you might be taking.
Yeah, I think it more than compensates for the extra risk that you're taking.
So that leads to the question, how do you identify a manager that has skill?
Yeah, that's the big question, right? What we're looking for, it's kind of like, if I put a public market analogy in place, it's kind of like a factor analysis in the public markets where you're looking for alpha, right? And so you rule out a whole pile of things that can be counted on as factors. So,
factors being natural trends that occur in the market anyway.
Yeah,
and trying
exactly.
to identify the people who are adding more value than just what would naturally happen.
Yeah. So, what was the beta for a software company over the last 10 years? How do you take out leverage out of that? How do you think about, did they get lucky with a particular company and sector or timing on something, and take timing out of it? Because that's another factor that drives returns. And you're kind of left with a leftover. Now, what we see, so that's quantitatively. What we see qualitatively is we see groups that do certain things in their companies over and over again in a repeated fashion that drive returns in those companies. And that's part of what we're looking for. It's very forensic in that regard.
So that's in private equity?
That's more in buyout, yeah.
In buyout. And going down to the other end of the spectrum in venture capital, does the same apply in terms of identifying skill?
No. So in venture capital, it's a little harder, right? It's quite a bit harder, actually. So what we're looking for in venture capital is individuals, because it's not even firms at that level, it's individuals that are plugged into the entrepreneur network. So, who are the people that are backing today's hottest companies? Who are the people that are plugged into the next best thing? Where are those people coming from? Who do they associate with and affiliate with? Who do they co-invest with? What are they doing in those companies? A lot of it, depending on where the company is in its life cycle, it can be about making introductions, getting them in front of other companies, getting them into capital markets. Today, finding sources of capital for them. So it's a lot more hands-on, but it's a broader hands-on set of tools that they apply to these companies. But it doesn't, it kind of doesn't show up historically right? Because if you're looking at a venture firm's track record today, it doesn't really reflect what the venture firm does today. It reflects what the venture firm did 8-10 years ago.
Well, on that point, with venture and with private equity, how much can you rely on a manager's track record to sort of isolate that skill or the repeatability factor you're talking about?
Yeah, so not a lot is the answer, right? I think there's a study out there that sort of says, if somebody is upper quartile today, the probability of them being upper quartile in their next fund is 25%, right? So statistically insignificant in that regard. And so what we think is, so venture, let's take venture first. So the track records in venture, as I said, were kind of created by the team sort of 8 to 12 years ago. That team's probably changed, strategy's probably changed, a lot of things have happened. And so the realizations today in venture aren't reflective of the current team and the current performance of the current team. And that's where being plugged into those networks of who they're working with and which entrepreneurs is really important to making that evaluation. So venture is challenging in that regard. We've also in venture, as part of sort of this massive price correction we've seen over the last 18 months or so, that hasn't really flowed through into venture valuations. So if you look at the performance of a venture fund today, it's not really reflective of the true performance of that fund because they're marking assets to the last time they were priced, which might have been in 2021, right? So we deal with a lot of overinflated performance numbers in venture today because of the way they value their assets on the whole, on the vast majority of cases. In buyout, it's a little different. The valuations were more kind of simpler and more straightforward. It's kind of earnings times multiple, get the multiple from the public market. So the price is there and the valuations they're correct. A little more real time, slightly lagged, but a little more real time. But the interesting thing about looking backwards at buyout valuations and private equity in general is that we've kind of come off this decade of really easy money, right? And in that decade, you could fall out of bed and earn a 9% per annum return, right? If you bought a company in 2016 and you put leverage on it, and you sold it in 2021, you could have made a 25% return by doing nothing else, per annum return by doing nothing else, right? And so the performance of these funds over the last 8 to 10 years really masks the whether there's skill being applied. You've been rewarded for taking risk, and the more risk you took, the more reward you got. And so some of the better performing funds could have just been people who took lots of risk. And so this isn't that environment. The environment's changed markedly from that. And so when we're looking at track records, again, we've got to be really forensic and say, where's the evidence of skill on that track record? Because this is the environment for skill.
And a lot of that was predicated on a lower interest rate environment that enabled them to generate higher returns through more leverage.
Yeah.
And you're saying now interest rates are higher, that leverages itself to more skill being required.
Yes, exactly. And maybe put a couple of numbers around it. So, I said you could earn a 25% per annum return on an asset just through the use of leverage and an expansion in market multiples. And so over the course of 2016 to 2021, that was a very easy way to get that kind of return. Now, you're not doing anything to the company in doing that. You're not applying any skill to the company. That generates a premium on top of that. So in today's environment, you can't get as much leverage. It's more expensive, and there's kind of no movement in market multiples. So that might get you to about a 10 or 11% kind of return, which after fees by the managers gets you to about a 6 or 7. Right, really uninteresting. So what you have to have in order to generate outsized returns is you have to be adding value to those companies and delivering using skill to deliver value to those companies.
Okay, and is there anything else that investors miss when looking through to private equity?
Yeah, there's a few things, but I think two really come to mind. The first is I continue to be surprised by the number of investors who view this as a transactional business, right? And this is actually a relationship business. We're at the very relationship intensive end of the asset investment game. And so, it's amazing the number, and even sort of large institutional investors and sovereign wealth funds and pension funds and superannuation funds that actually view this as a transactional, your counterparties to a transaction rather than forming a partnership, which is actually what you're signing up to. You're forming a partnership with people. And I think that comes unstuck for a lot of people by doing that. And then, because I think you miss the evaluation of the partner, which is key here, right? If you're forming a partnership with someone, you've got to be able to evaluate the partner. I think the other big thing is just, sort of, we've seen this sort of flight of capital towards big brand names, and they get bigger, but by getting bigger, it limits what they can invest in. And that kind of doesn't work. It doesn't hold sort of when you've got.
You mean brand names in private equity specifically?
Yeah. And so, but even like private equity firms or even the allocators into private equity, right? And so, when you've got sort of single billions of dollars a year to put to work, like we're doing in Future Fund, we didn't really notice sort of this diseconomies of scale that happens. There were some parts of the market that were out of bounds to us, but not a lot. When you're putting tens of billions of dollars to work, 20 or $30 billion a year to work, for your clients or for investors, you are restricted on where you can put that money. And so that is not necessarily going into the very best opportunities. And so I think investors kind of need to be cognizant of that when they're looking to make allocations into the private markets.
Great. And we hear a lot of managers say that private equity tends to perform well after a downturn. Does this make now a good time to invest in private equity?
Yeah, it's a fantastic marketing pitch, isn't it? There's a lovely graph people show with two humps in it, showing the increased performance in private equity immediately post the 2001 recession and immediately post the 2008 recession. Those, and actually we've done some work ourselves, which shows that the skilled managers outperform by even more through both those time periods. And so why does that happen? It's principally because the private equity firms tend to invest more into their companies into the down part of the cycle than the public market would do, right? And they tend to go and acquire more market share in those down parts of cycles. So a lot more market share changes hands through those parts of cycles. We also see an uptick in innovation through those parts of cycles. People lose their jobs, and therefore, more companies are formed, and there's more innovation created as part of that. So that's kind of the case for it. The case against it is basically the answer I just gave you about why this cycle is going to be different to the previous ones, and that that skill really needs to be applied to be able to generate that outperformance in this part of the market, in this part of the cycle, and that unless you're investing with the very highly skilled groups, I don't think you're going to see that outperformance bump that would traditionally have been there.
Well, given that, we're looking forward, where do you think the opportunities may lie ahead, looking at the private equity landscape?
Yeah, so one of the things we really look at is funds flows, right? Where's the capital going versus where is it not going? And so that informs us a little bit about where to go looking for opportunities. So in that vein, I think right now venture looks really interesting. We're in the middle of a very broad innovation cycle. It's multifaceted. It's got a long way to run, and valuations are off a long, long way from their peaks, right? And so new dollars into venture, as opposed to dollars into existing venture-backed businesses, new dollars into venture look really interesting right now. And there's not a huge amount of them going into things outside of AI. We think there's a real value to being a liquidity provider. In a liquid asset class, when liquidity is tight, there's some real outsized returns to be generated by providing liquidity into that asset class. And so we actually think, opportunities around secondaries and being a provider of capital to provide liquidity enables you to extract an outsized return in this environment.
So secondaries being when you're buying businesses off existing private equity companies that want to sell them?
Yeah, so secondaries, good point, we didn't touch on that, but secondaries are, if you think about all those different stages that we used at the beginning to talk about the company through its life cycle, the secondary is sort of doing the purchase of the existing shares in that company. So if you think about a public market equivalent, when the company goes public, it makes a primary issuance of capital, and then the market itself is a secondary trading exchange. And so the private markets, there are secondary ways to go and trade these illiquid stocks through the secondary market. And so there's just value today to being a liquidity provider in that market when the market's pretty illiquid.
So structurally, companies are struggling, or funds are struggling to sell their businesses. There's no liquidity there, and by coming in, being a buyer of those businesses, you're getting them at better values, and you're seeing that as a big opportunity going forward.
Yes, and you've got to pick your spots carefully, but because the market's such a broad and deep market, because the private market's so huge, you can find pockets of value in doing that.
And just touching back on what you said about venture and the valuations coming off earlier in our conversation, you said that some of the valuations have not been adjusted.
Yeah.
So where have they come off, and where do they still need to be repriced, and how long do you think that will take?
Yeah. So a lot of it's got to do with how the valuation policies work in venture capital firms. So it normally says last round valuation unless the company is operationally impaired. Now, so if the company went and raised capital in 2021 at the peak of the market when capital was basically free, then they can still be holding that company at that valuation, even though today there's no way to raise capital at the same kind of valuation, right? If it's not operationally impaired, they don't need to mark it down. And so what we will find is as those companies get to a point where they need to raise capital again, then they're going to have to deal with that issue in one way or another, right? And so, that's where the track records for VC firms in particular kind of mask all of that. You've kind of got to go through and revalue all the companies in the portfolio to be able to work out what the real track record is right now. It's quite a challenging exercise in that regard.
So when you're saying investing into VC as a good opportunity and venture going forward, in identifying the right funds, you've got to properly assess their track records and understand how they've been valuing recent funds effectively.
Yeah, exactly. And then, we've spent a lot of time talking about skill. And so this is the time for skill. This is the environment for skill. And so we think that the highly skilled private equity managers are going to be able to still generate, the kinds of returns that we've been able to expect from this industry over the past, 10, 20 years. So, but we think you've got to have a high level of skill in order to do that.
And you said that the innovation happening in the startup venture capital area is very appealing. There's a lot going on at the moment. Is it primarily AI? You said AI is obviously getting a lot of interest and money. Are there other sectors that are innovating that you find interesting?
Yeah, so it's not, so there's a very broad spectrum across, technology and what's happening in technology. And it's kind of, permeating into every sector. There's a lot of hype around AI. And actually, my view would be AI generative AI at least, favors incumbents today. So existing businesses applying it to their own data. A startup doesn't have the data to apply generative AI to, so it's a little more challenging for them to do that.
Thanks, Steve. It does sound like there's a lot of opportunity in private equity and venture capital still ahead, but also quite a few things that investors need to watch for and consider. So thanks for highlighting some of those things to us and for joining us today. And thank you all for listening.